It ended up being a $10 million asset by the time we got his numbers correct. And the savings was $2.5 million. That's just one this morning. Yeah, this happens every day, all day long. Why didn't my accountant tell me about this? I'm going to fire that guy. And I'm like, well, wait a minute. Don't fire him. Let's just educate him. This has been in the tax code since 1997. It's nothing newfangled. We've done this 50,000 times and counting and never triggered an audit. And in fact, it's considered by the IRS to be the certain method. It's really the preferred, more accurate way to depreciate.
Meet Stacy Sherman, tax savings specialist, who reveals how to unlock hidden tax savings through cost segregation in this episode of Real Estate Profit Boost with Jerry Katz, CEO. We'll explore why most investors are throwing away thousands, literally, how to avoid missed depreciation and generate insane returns. If you're renovating or investing in 2025, this might be your last chance to avoid throwing cash in the trash. Let's get started.
So I'm glad I have your platform today to be an evangelist for this because it's so much money. Well, there's cash in that trash, so don't throw it out because of two things. If you don't take this tax savings the year you replace, you have lost out. Snooze, lose. We usually see ROI far and above that, 50, 100. I mean, it's crazy money, yeah. Oh yeah. It's 10 is bare minimum, yeah.
Welcome once again to our Real Estate Profit Boost podcast, YouTube channel, and everything. And today I have the pleasure of Stacy Sherman, a rock star friend. We actually grew up in Michigan together. We didn't know each other, but we met in this wonderful world of real estate. So as you know, the show focuses around profit boosts and increasing net operating income. And I will tell you, you're going to learn a lot today. And I have a feeling a lot of you don't even know what she does. You know, even your experienced real estate investors don't know what she does, but she increases your net operating income and things of that nature. So with that being said, I'll give you just a quick introduction because I don't like those long bios. But long story short is Stacy has over a decade of experience on cost segregation. And she's a senior executive at Cost Segregation Services, which has done over 50,000 cost segregations in this country on real estate. So that's billions of dollars of real estate. And one thing she mentioned to me, in passing is they've never triggered an audit with the IRS, right? So obviously, a lot of us own real estate who have high income businesses and things of that nature. We own them, real estate doesn't always cash flow for us, but should, but we do it for depreciation. So she is an expert in this, and we're going to get into it. So let's just start off. Stace, thanks, by the way, for hanging out with us and joining us. And I just want to start off with not everybody knows, right, what cost segregation is or anything of that nature. So tell us, like you're speaking to a 5-year-old, because the audience is anything from an institution watching all the way to someone who bought their first investment property or a fourplex. Tell us, like I'm a 5-year-old, what is cost segregation?
Well, thanks, Jerry. I like the introduction and the Michigan memories. I appreciate that. And it's an honor to be here, and it's an honor to help people maximize the tax code because you're right. I would say 95% of the people who should know about this do not. And it is a little complicated. So cost segregation is the other way to depreciate a building. It's the more tax advantageous way to depreciate a building for most building owners. So the other choice is straight line, and that's what most people do just by default. Our study allows building owners to accelerate depreciation. So it's the same amount of depreciation. They are going to wait 39 years or 27 and a half years, but they're able to front load up to 50%, sometimes even more than 50% in the first year or couple of years. So we like to say it's about time value of money. Mm-hmm. The more losses you have today, the less you're paying in income tax. That's money you're freeing up to invest in this building, another business, a
Understood.
vacation. Yeah.
Okay. So, question. So, my basic knowledge on depreciation, right? You mentioned 27 and 39. So, when you buy a piece of real estate, right, what doesn't matter if it's 1955 year construction or 2025 year construction, you depreciate that asset. Standard is what, 27 or 39? What's the
27 and
difference?
a half is for
27 and a half.
residential, with the exception of short-term rentals, but apartment buildings, single-family homes, residential is 27 and a half, and pretty much every other commercial property is 39 years, which is a long
Okay.
time, right?
Which is a
Either
long time.
way, either way, it's a long time. Yeah.
Right. Okay, so if I have a 10, so residential is 27 and a half years. If it's a short term, you can accelerate it quicker, or it's considered the 39 as a piece of commercial.
39, they're treated like hotels. Now, not every tax professional gets this right. There's a lot of mistakes we see, but it's supposed to be treated like a hotel and depreciated over 39 years.
Got it. Yep. Same in the insurance world, same thing. Different on general liability versus short term versus long term. It's a huge difference, and most
Okay.
of them don't even know. Okay, understood. So depreciation at its core, if you have an income of $100,000, whether it's on that property or on your, whatever other income you have or business, you can basically what? You can expense depreciation from your gross income. Okay.
Right.
And it just so you're not paying as much tax, right? You're lowering your tax bracket, you're adding expenses. Okay, so that's it. We're pretending we're 5-year-olds and we don't know all of this kind of stuff.
Yeah.
So a question: when would I need to really accelerate depreciation? Because if I'm not mistaken, the way, like, if I have a capital gain and I sell a piece of property and I have $1 million capital gain and I decide not to 1031 or buy another piece of property, I'm going to be paying 22%, capital gains tax, 22 and change, right, under this administration. So is that a perfect example to find an old property that I have that's 10 years old to do a cost segregation report? So using that as an example, let's play out, that as an example. How would it benefit and how does it work?
That's interesting the way you pose the question, because I would say that's not always what we run into. But anytime you have a tax liability and you have not done a cost segregation study, there's tax savings hiding in your walls. So even if you've had the building 10 years, like you just mentioned, it's definitely worth taking a look at to see how much would be available by accelerating. Typically, cost segregation is applied to ordinary income first before capital gains, because that's taxed usually at a higher rate depending on the client's tax bracket.
Makes
and
sense.
then any kind of leftovers could be applied to the gains. Just depends on that person's individual income.
Okay. So the advantage of the cost segregation is what? So give me an example. Let's say we have a $5 million property. It's I don't know if this is important, 1976 construction. It's a multifamily, long-term rentals, right? And I have, income of $50,000 reported for the year on that one. And then I have a business, let's say Premier Protection, and I'm reporting $200,000 in income, right? Take me through a sample. Why would I use it then? Or should I save it for another time? Or just the basics of how it works.
No, there's no reason to save it, because unused losses carry forward. So you can either you can start a building off with cost segregation, and then anything unused carries forward indefinitely.
Okay.
The other option is, if you already have an asset and you have not yet done cost segregation, it's not too late. You could do cost segregation now, let's say when you want to reduce your taxable income, and you would not amend your prior returns. There's a lot of misunderstanding around that, because we don't want to amend our returns. That kind of does trigger the IRS to scrutinize. We
Okay.
do this by filing, it's called Form 3115 Change of Accounting Method. The change is retroactive. So the person we talked about who's got a 10-year-old asset, and we figure out there's a bunch of losses that they could take now, they'd file this form, let's say in 2024, 2025, and the change is retroactive. You get caught up. You catch up on the depreciation you missed out on. And
Understood.
that's the method to do that. Yeah.
Okay. So maybe I'm jumping ahead. Let's explain to the audience what you do and how and what to expect. So, like, again, if we could use that $1 million piece of property that I purchased 7 years ago, it's a multifamily, long-term, because all that matters, right? Because the tax laws are different per types of classes of real estate, as you mentioned, short-term versus long-term. If I'm wrong, let me know. So, okay, break it down. I call you up. I say, listen, I got some income. I need to, get some more losses, as you call them, right, or depreciation. How do I do it? I got a property I paid $1 million for 5 years ago. What's the steps?
Well, our company starts with a no cost, no obligation estimate. So you would send us that depreciation schedule, an address, and we'll look at that property and we'll illustrate for you and show you what tax savings is available by changing your accounting method and doing accelerated versus straight line, which you've been doing for the years since you've owned it.
Got it.
Just to give you a ballpark number, on average, for every $1 million in building costs, a client's going to save in the neighborhood of $50,000 to $80,000. So if they've had the asset, you said, for 5 or more years,
Right.
it's going to be a little bit less because they've already taken some depreciation. But starting out of the gate, a building that's new to you, could be an old building that's been around 100 years, but you just recently acquired it. On average, your tax savings is over 50,000, 60, 70, 80,000 per million in building costs. So it's not nothing. It's a substantial amount of money.
Okay, so maybe we should get more simpler. Let's say, right, because for me to understand that, am I saving that in not paying income taxes, or am I taking a quicker depreciation expense? So if I bought a building last week, forget the old schedule, right? I get that. I've been depreciating a building for 27 years. I'm only capturing whatever, $10,000 or $25,000 a year as a loss off my income, right? Now I bought a building last week and I paid $1 million and I haven't depreciated anything. Let's say it's a 1975 building it matters, right? How old the roof is, the paint, any of that kind of things, or no?
Well, everything is relative to the cost basis. And by the way, any building, it's not just multifamily, it could be any building except a standalone parking structure, is going to be some degree of good. We can carve out usually at least 20% for faster depreciation, up to more than 50%, depending on the asset type.
Okay.
So, yeah.
So give me that example. I bought a building last week for $1 million, and now I call you. Take me through the steps and what I really would be depreciating first year, second year, what's my savings, all that good stuff. And that's what I'm talking about. Listen to that value. Listen to those strategies. Listen to those secrets. Now, if you like what you hear right now, I need you to like, I need you to subscribe, and I need you to share with a friend, that's right, who wants to scale in real estate. And even more importantly, maybe you heard something that we didn't. So put a comment below and share your insights on this video, because you know what? That's what this channel is about. Learning and growing from each other, and you may see something that we don't. So this is Real Estate Profit Boost, where people learn how to scale in the world of commercial real estate.
So everything is relative to the cost basis. So first I would ask you if there was a 1031 exchange, because remember, if you 1031 exchange, that deferred gain is going to reduce the basis in this new property. So let's just assume, since we're talking about $1 million, let's assume this was just a straight purchase, not a 1031. And then remember, every property has some percentage that's allocated to land, and land is not depreciable. So $1 million building doesn't give you $1 million of depreciation, probably more like 800,000 or so. So
Understood.
typically 20%, depending on where you are,
Where does that
is
number
land.
come from? Does it come from a replacement cost estimator? Does it come from the property appraisers? What they have said?
Well, that's a whole nother. We could do a different YouTube on that.
Okay.
There's a handful. There are a handful of ways to arrive at that cost basis. There's not one way. It is a bit of a gray area, so we could talk about that later. But we might get confused at this point. We should probably stick to depreciation. So let's just say we have 800,000 now in depreciable basis on a $1 million straight purchase of a multifamily building. So without our study, that $800,000 would be evenly divided over 27 and a half years. That's what most people do by default. It's just straight line depreciation. But what we would do once you engaged us is come out to the property and we break the building down to its parts and pieces. So we would break out the flooring, the cabinetry, the parking lot, the fire and security, data, awnings, dumpster enclosures. We break buildings. That 800,000 is no longer just one line on the depreciation schedule. Now it's 20, 30, 40, 50 lines where we've broken out all the parts and pieces. And when we do that, we reclassify. Some of that stuff goes into the 5-year bucket, if you will. Some goes into the 15-year bucket. And then the structure, the roof, the foundation, that stays on 27 and a half. So everything that went, the rest of the stuff went into these faster categories. And today, right now, when we're recording this at the end of February 2025, bonus depreciation today is at 40%. Is it likely to change this year with the new administration? I would think so, but let's just stick with today's laws. That means everything that we put in, let's say 20% of that 800. So now we're at 160,000 of the 800 goes into the fast depreciation categories. In 2025, you can take 40% of that in year one. That has to do with the Tax Cuts and Jobs Act that was passed under Trump 1. That's
Understood.
currently phasing out.
So that's 40% of the 800.
40% of the 160.
Okay. 40.
You can
okay.
take today for fast depreciation in 2025. The other 60% you'll have next year, the year after, the next couple of years.
Okay. So if people out there are assuming that on that example at $1 million, you came up with $180,000 in accelerated depreciation. Is that right?
Yes.
Right, I heard?
Right.
And you can take 40% of the $180,000 in your first year because of the current tax law.
Correct.
Normally would be 20%. Okay, so there's a lot of people that I've talked
not
to.
20.
Right.
I don't know where the 20 came from.
20% of the 800,000 was your 180,000 in depreciation or losses, that you call it. Nope.
No, 20% we said was land.
Okay.
I know this is
right.
confusing.
Yeah, well,
And we don't want to
okay.
confuse everybody, because every year the last tax law, the Tax Cuts and Jobs Act, is phasing out. So nobody who's listening to this has to memorize what are the rules this year. They could just contact you or me, and we'll put the numbers in front of them. Because yeah.
So out of the $800,000, of $200,000 goes to land. What could they expect as a depreciation amount if they chose to use, cost segregation on that?
So cost segregation, they're going to get 160,000 in the first few years, and of that 160,000, that's 64,000, 40%. I hope I'm doing the math right off the top of my head, is available year one. That's a whole lot more than 1/28.
Right. Yeah, I was going to ask. I don't have a calculator, but I don't know what 1/28 of 800,000 is. But it's
less than 2%. It's less than 2% if I did that right.
Right. It's $16,000 a year.
Is what you'd get straight line versus
Right.
64,000
versus
in this scenario. Yeah.
Okay, understood. Okay, So, and obviously, my next question, I think, for myself is what's a study like that cost? Ballpark on this example.
Most studies today range between 3,000 and 10,000 per building. This is going to be at the lower end, what we're talking about here.
Mm-hmm.
You know, like $1 million building, a few $1,000, which is an ordinary expense, which you could
Right.
write
No,
off. You don't get to write off what you pay the IRS, but you do get to write off our fee.
right. Okay, so it's an
Yeah.
expense, right to the
Yeah.
business. I mean, listen, for me, you clarified a lot of, fallacies or whatever you want or what people think and that kind of stuff. Because, I was at a real estate convention and they're like, yeah, I'm going to dollar cost segregate my new building. It's $4 million. So what does that mean? Oh, I'm going to get at least $2 million, dollars, half my first year. And I was like, are you sure about that? And I think you just clarified that for a lot of people that do have heard of this, but not necessarily have done it themselves and so on. So did you
So I
get
just
that
want
a
to
lot?
clarify. Well, during the 5 years, so when we had the Tax Cuts and Jobs Act, which was passed in 2018 for 5 years, so through 2022, bonus depreciation was at 100%. That meant you could take everything that went into the fast categories, the 5, 7, and 15 categories, you could take all of it year one. It
Okay.
was bonkers. It was really fun. And we're probably having that come back this year, but we won't know for a few months. So I don't have a crystal ball, but that's what it's looking like. So maybe when you were at that conference, if it was back in the heyday of bonus depreciation, maybe.
Okay, so a lot depends on the current administration and the current laws and when they expire and all that good thing. So that did exist at one time. Okay. So even let's say, you don't have a business like myself or so on, and you just own real estate and you don't cash flow a lot, right? In your first year, or you're doing a value add like a rehab or something like that. Is it still worth it to do it the first year?
I think the individual has to probably make that call because remember, unused losses are going to carry forward. So if
And your
you don't take it
definition.
the first year, you're not cash flowing. The second year, you're going to do this change of accounting method we talked about before. That does add to your cost. We
Okay.
charge, whatever. There's going to be a cost incurred to do that.
Do you have to use if you do the study, do you have to continually use it? Whether it's 20%, 40%, or 100%, depending on the tax law. Do you have to continue to use it, or can you pause it 1 year, use the percentage of the loss, the depreciation, or does it continue?
Well, it's interesting that you use the term pause because that's not a term we use in this business, but the way it is set up now, it's assumed that you're going to use whatever bonus is available to you in the year we're talking about. And it goes based on the year you place the building in service. So if anybody's listening and they bought a building during the 100% heyday, they would still get 100% if they did the study today. So no, that's number one. Number two, it's assumed you're taking all the bonus that was available at the time you bought the building, but you can opt out. So I don't know if you call that pausing, but you can opt out of 5-year bonus, opt out of 15-year bonus, or opt out altogether. So you kind of spread it out more.
So, interesting. So you can opt out at any time if, for whatever tax reason, it makes sense at that point. Can you bring it back, or you have to re-engage in a study?
Oh, no. You're just taking less depreciation that would have been available to you, and you're just carrying it forward to the next year. You have to take depreciation every year, even the straight line portion, because you know why? Because when you go to sell your building, if you didn't take your depreciation, you still have to pay it back, which we don't want to talk about that right now. Most people don't make a mistake, but some do. So we don't want to talk about the exceptions. But.
So this is a kind of strange question. Now I'm starting to see clear here. So if I did sell a property 1 year right, and had $1 million capital gain, and did not 1031 those proceeds, and I was subject to long-term capital plus ordinary income, right, on my other stuff, and I bought a property in the first year. So that could be done simultaneously, right? Say
Some
I bought a
people,
smaller property
yeah,
or just something else, right?
some people call that the lazy man or the lazy person's 1031 exchange.
Interesting. Okay.
Yeah. So, because remember, when you 1031 exchange, you're bringing in that deferred gain into the purchase price, so your cost basis goes down. Whereas if you just buy the building, you're going to have more depreciation. So it's a lazy, I like that term, lazy person's
Right.
cost seg, if it works out time wise for you,
And
in
there
the
may
same
be some
texture.
advantages to that, right? Because you can free up capital on the sales side, opposed to committing all the capital into another property or use leverage debt, right? So it's all binary. Real estate is numbers and underwriting and everything of that, so on. So
It frees people up not to make kind of like maybe not the best business decision because they're rushing to meet their deadline in a 1031 exchange and trying to buy a building that maybe is not ideal. Maybe they could wait a little bit longer, find one that fits their business intentions better. But I would like to bring something up because you said value add. You mentioned value add. This is my favorite tax hack. I'm going to share it right now. So few people know about this. Almost everyone misses it, and it's my favorite thing. When you have a value add, when you improve a property that was in service, and preferably in service the prior tax year. So we're in February. Let's say you closed before November or before last year, 2024. Now you're renovating. Now you have a dumpster at the building and you're ripping stuff out. You're ripping out carpeting or flooring or fixtures or drywall, whatever it is.
right.
Think of cash in the trash. That's the easiest way to remember this and simplify it. You get to write down the remaining depreciable basis of what you toss out.
I want to take a quick break to ask, did you enjoy the video so far? If you want to learn how real estate titans make millions, hit that subscribe button now. Join us on Real Estate Profit Boost with Jerry Katz at Jerry KatzEO for expert tips and insider strategies to grow your wealth.
I call it the demo, right?
Now,
so
there's-
I buy value
there's mo-
adds, yeah, and then we
So let
demo
me-
and toss it in the dumpster, right? Go ahead.
Well, there's cash in that trash, so don't throw it out because of two things. If you don't take this tax savings the year you replace, you have lost out. Snooze, lose. Okay, so you finish this renovation in 2025. You have to be calling us or your cost seg person because if you don't take it, you will lose out. There's no look back. So cost seg, we could do it at any time of ownership. But this thing I'm describing, this cash in the trash, the official name is partial asset disposition. PAD, it's cash in the trash to me is easier to remember than that long phrase. Those savings are in addition to the cost seg savings.
Got it. And since it's in the trash and it's out the door, there's never a recoup of that depreciation, right? Like when you sell
Right,
it or anything?
it comes off the depreciation schedule, so you're getting rid of what most people have on their schedules are phantom assets. They're still depreciating something that's gone and it's been replaced. So the correct thing, the IRS preferred method, is to do this. So we do an engineering based study, just like our cost segregation studies are engineering based, where we'll identify the things that were thrown out and the remaining basis of those parts and pieces. So you have a long report, like a cost seg report.
Right. So will we call you before demo? So for example, I'm a value add, investor. We'll go in, we'll buy the property, we know our strategy, and then we go and we get an estimate. We're going to spend $15,000 per unit. The demo is this. Is that the time we reach out so you can before it hits the trash, right?
Yeah, because, with a lot of people, I can guide you and tell you, look, if you hold off until this date, you'll get this tax benefit. But if you do it now, like if you buy it and start ripping stuff out in the same tax year, you're not going to qualify.
That was
It's
my
got to
next
be,
question.
it
Yeah.
doesn't actually have to be the separate tax year, but there has to be a period of time. And that period of time has never been identified specifically.
Right, because at the beginning you mentioned if I bought it last year in 2024, I have to wait for cash in the trash till 2025, right?
To start ripping stuff out, there has to be a time period. So the IRS won't give it, it's if you bought this property knowing these things had to be renovated,
Right.
you're not really qualifying technically. But if you're sitting in the building and now you've been there a couple months, you're like, you know what, I think I'll move this and that, and I'll renovate this and that, then you do qualify.
Okay. So it can't technically be part of the project, right? So listen, when I buy a value add, I'll buy it in June, and then my whole thing is okay. If it's 10 units, I'm going to take 1 or 2, 3 units at a time, start rehabbing, keep cash flow coming in from the current, but others don't. They'll vacate the whole building. So in that situation, it doesn't work. Or is there a 90 days? Should I keep them there, or it has to roll into the next calendar year?
The building has to be in service, so it has to be rented or rentable.
Okay.
So you can't go in, kick everybody out, gut it. You're not going to qualify.
So even if I keep 1 or 2 tenants in there during my value add,
You're
it's
good.
inserviceable. Is there a time period? Because listen, the devil's in the details, right? Because we don't want to trigger audits or anything like that.
Yeah.
What is there a specific period of time that the building has to be in use to get the cash in the trash?
Unfortunately, we don't have clarification for over a decade. I'd say for 50, my company's been in business 20 years. For many, many, many years, we've been telling people it had to be a different tax year. And then last year we got some clarification that it actually could be you bought the building January, February, March, and then you did this renovation end of the year. But we never got an actual number of days, weeks, months, so I can't answer that.
Right. So, listen, my first year when I do a value add, right? Let's say I don't make money, right? Because I got to pay mortgages, taxes, insurance, all that. And let's say I take 6 months to stabilize. So the first year, I may lose $20,000, let's just say, until we start stabilizing the buildings. Now, let's say I threw out $200,000 worth of that. Let's say whatever's useful is half of that or less, right? 30%, something. So that's just another loss on my first year. And that carries forward? Because
Well, hold on. Now remember, the losses are done at your entity level, but they flow through your K1. So assuming
Correct.
you've got other income, the losses don't have to be applied to that building. It's in total. It's,
Understood.
Yeah.
Wasn't there a rule that you could only move, like, on the K1, like you said, on the 1040 and everything? Isn't there a rule that you can only carry so much in losses and forward? Like 3,000 at one time or something? Or has that changed? Maybe I'm wrong.
I'm not exactly sure what you're referring to, and it could be. Now, remember, I'm not an accountant, so...
Right. No, I get the cash and the trash and the cash. Cash and the trash. You got it.
Cash in the trash. Cash in the trash.
I think you mentioned that to me at one time. And listen, that's very valuable. And a lot of people, we underwrite real estate. We don't even look at those little pieces. So, question for you.
Let me tell you how valuable. I just want to say something.
Yeah,
I meet people every day. It really upsets me when I do run into people who have done this and they've missed it. Because I forgot to put a number on this for you. What they lost out by missing out on this, because trust me, most accountants, unless they're super real estate oriented, and which is the small minority of tax professionals, they're not up on this. They don't know it. Maybe they're just not paid enough to advise people on this. But what they missed out on was the approximate benefit is about 20% of the replacement. So if you did a $500,000 renovation, that's $100,000 in losses you lost out on because you didn't know about that at the time you replaced it. And that is true, I would say, of 9 out of 10 people who are renovating properties. It's just sad, and it upsets me. So I'm glad I have your platform today to
No.
be an evangelist for this because it's so
Listen, I
much
didn't know
money.
this. Yeah,
Yeah,
I didn't know this
nobody-
20 years ago. I didn't know it until today. Really, the specifics of it, right? And when we do value adds, I'm throwing out bathtubs and kitchens that are 20 years old, so they're all depreciated or whatever. We
No,
consider them
they're not
junk.
depreciated.
They're not. You said replacement cost. So if I'm
Well,
replacing
depreciation
$5,000
starts.
go ahead.
Depreciation starts when you acquired that building.
Right.
So it's new. So if you paid $1 million, it's some portion of that million that we're talking about. Not that it was it's all relative to the cost basis.
Understood.
So,
But the cash in the trash is 20% of replacement cost of what's in the trash.
yes, that's right.
Right,
That's
not a current value, right?
Right.
I keep thinking in my head depreciation and insurance. We have actual cash value policies versus replacement cost value policies, and they depreciate it, and you don't get paid because it's a 20-year-old kitchen has no value, right? But replacement cost is the key. Interesting.
Yeah.
Okay, so
and that's a ballpark. It could be higher. It could be lower. This is just like a general rule of thumb.
right. I mean, listen, that's huge, right? So I'm going to ask you some fun questions. What's the biggest tax savings you personally helped a client unlock?
Oh, I don't have a number on that. I just sent someone a finished study today. It was in the millions. If I would have known, I would have had it sitting in front of me.
Right.
It was a 10 million. He thought it was a $13 million asset. It ended up being a $10 million asset by the time we got his numbers correct. Mm-hmm. And the savings was $2.5 million. If I have that correct in my head, yeah.
So this is just a recent case.
That's just one this morning. Yeah, this happens every day, all day long.
Those are big numbers.
But you know what? As exciting as the big numbers are, I truly, truly enjoy helping people who have couple $100,000 single family homes or condos, Airbnbs, or we do dollar stores in general all day long, because even like just the smaller person, it's very rewarding. Right. That $50,000 or $80,000 tax savings on that one small property, it's life changing.
No, of course, I get it. Well, what's the most common reaction that you get when investors realize they've been either overpaying or missing out on savings or losses? What's the common reaction?
Why didn't my accountant tell me about this? I'm going to fire that guy. And I'm like, well, wait a minute. Don't fire him. Let's just educate him. And let's
Right, 100%. Yeah. So the way that we do business at Premier, for example, for me, everybody who is on the show or in my vendor, my accountant, everything is real estate related, and my accountant has to understand. So I spent like 2 years trying to find real estate, accountants, and my client base asked me, Jerry, do you have a real estate accountant? I own 10 buildings now, and I used to be a doctor or whatever, and I'm like, and I can't find them. Okay, nobody is a specialist in real estate for some reason. So, and to this day, my head of ops had to find my accountant is now out of DC and Virginia. Okay, because that's how far we went to get him to understand all the real estate. So this brings me to the question is, when you do this for the client, and the client does it without talking to his accountant, what does the accountant do? Do they put up resistance? Do they freak out? Do you have to consult with them? Like, what's the reaction?
Well, usually, most people want their accountant's blessing. So right. the shock comes at the early stage. So let's say the building owner was referred to me or something, and we work directly. So then the accountant might have a negative response if they're not familiar or they just don't know real estate or whatever. So that's when I like to work with the accountant and help them understand and show them this has been in a tax code since 1997. It's nothing newfangled. We've done this 50,000 times and counting and never triggered an audit. And in fact, it's considered by the IRS to be the certain method. It's really the preferred, more accurate way to depreciate, to comply with the rules and regulations that were passed in the last 10 years. So I don't want to get too technical on people on the tangible property regulations. That's what it's called. So it's the certain method, it's the better method, but I would say the majority of accountants do need some help. And that's what we're here for. We hold their hand and bring them up to speed. And we actually offer CPE. We teach this stuff, continuing professional ed to CPAs and
right.
yeah, we do.
'Cause I'm
We have
sure-
like monthly webinars and stuff where we always get amazing responses like, "Wow, I didn't know this," or "This will really help some of my clients," or I'm like,
right. Listen,
"Okay,
Mike,
well, it's been around over almost 3 decades. Where you been?" But okay.
right. We just engaged
Yeah.
a new accountant. I brought it up because of you, right, to them, and so on. So I can imagine there's a little bit of a battle there. But listen, I got to say something because my producer always says to me, say something. So listen, we just learned about cash in the trash right now. So right now you're supposed to subscribe. You're supposed to share about Stacy.
Oh.
And you're supposed to share this. Yes, this is our audience that I'm speaking to. Like it, comment below, right? Because you right now, if you're a broker, if you're, anything that has to do with real estate, if you share this channel or you share her secrets right now, you look good. And you should share it to your account. So my producer, I always forget to say subscribe, like, comment. But I mean, listen, cash in the trash alone was huge right there for anybody that needs a real estate profit boost. And that's the whole purpose of this channel and so forth. But like going back to the conversation, yeah, I can imagine like you're educating accountants is probably a large part of what you do, right? Because they get too conservative. But like if I looked at a 30-second clip of this cast and we did it, you said 50,000 times we've done this, right? And never triggered an audit. So that's the truth, right? I always say data tells the truth and so on. So
I'll add one more piece to that, which is, anybody can be audited. So we have had more than about 24 clients who have been audited in our 20 years for whatever reasons. And that agent might open up the study we did recently or 2 years ago or 10 years ago or whatever, they'll open up the study, and we've defended our studies 24 times with 0 reversals, no issues. So
Okay,
this is kosher.
right, I like that, kosher, and you've defended and everything. So let me ask you a question. I'm sure you have multiple clients, right? Do you have clients that literally are full-time real estate investors that every property they buy, this is what they do?
Oh yeah.
Right, everyone.
I like the fact that I'm in the only business that I've ever been in all my working life where we have only happy clients. Everyone loves saving money on income tax, and anybody who's worked with us before and buys another building, we're one of the first calls they make. Sometimes even before they buy it, to say, Stacy, what's the savings going to look like before I close on this? And I'll put those numbers in their hands. It kind of moves the needle on the deal. The brokers like that because, can kind of push them to go, oh, wow. And there's all this tax savings that comes with it, too.
That's huge. Yeah. So we do the same things, right? So that's very valuable. So a lot of people they think, for example, in insurance, right? They get an insurance quote, that's it. No way. I fixed insurance for real estate 20 years ago because I couldn't take the prices, the valuations, the doubling, killing my NOI. So now we offer the same strategy that you just mentioned. So if I have an investor who's buying, they call us first, and if I can lower the insurance expense literally by $10,000, I technically increase the value of the property at a 5.5, 6 cap at $180,000. They don't realize how powerful it is. So you, which is the first time I'm hearing it, you can do the exact same thing. So those investors who are complaining right now saying, I can't buy a deal, there's no deals on the market, I hear it all the time, or it's stagnant. Right, because if they call you first, now we have an edge. It's the same thing. Awesome. And brokers, wow, see, it's very interesting.
I love working with brokers. Yeah, they've definitely made my life. It's really fun because I get to make them tax savings heroes even when they don't even understand half of what I'm saying. They don't understand the terminology. They don't have to. They just kind of put us together with their client, and we'll put those estimates in their hands. And
Also, if you want to increase your net operating income by lowering your insurance costs? Look down below. There's a free PDF that will show you the secrets on how to do it. Can't do it yourself? Go down below. There's a link so you can schedule a meeting with one of my advisors. Remember, I solved overpriced insurance. That's right, for real estate, for myself and all our clients. If I can increase your net operating income by reducing your insurance costs, I just increased the value of your property. The best time to do it is always, but what if you're about to get a cash out refi? We can increase that by lowering insurance costs. What if you're about to sell your property on the market? Increase your net operating income by lowering insurance costs. You get a higher price. Go down below, reach out. I'd love to show you my solution.
Right.
It's
and
just
how
fun.
many brokers, when they go out for a listing or selling for a client or purchasing, they don't even consider this. Probably 95%. Right. Same in the insurance world. This same exact thing. So one question is there any class of real estate that this doesn't work with?
I think I said in the beginning, the only thing that doesn't work is a standalone parking structure. We work on everything else. Mobile home parks, you wouldn't think, right? Those are actually really great. Golf courses, skyscrapers, single family homes, you name it, it works on every kind of property.
Just for the audience, as long as it's a rental property, not your primary residence or anything
Right.
like that.
Any
So-
investment property or commercial property.
Investment property. So I'm a limited partner in Broadview Capital Trailer Parks.
Oh,
Yeah.
you're a
So it's
client.
I'm a client. You know Larry?
Look at this. I sure do. Yeah.
So I'm a limited partner in Broadview Capital. Yeah, Larry's a...
Well, you've had a lot. Those are great ones. They came across great on depreciation. Those
I'm a
came out
client.
much.
Didn't even know, right?
That's so
Actually, I did know.
fun.
But go ahead. No, I didn't
You
know.
did? I didn't
No,
know.
I didn't know. Not on the trailer parks. I didn't know.
He's a
So
nice
you
guy.
know Larry, yeah. So I've known Larry for a decade, right? But how do I get to know these people is because for me, when we do business with each other, people do business with people they like, but also share my values and integrity and all that. That's why you're here, Stacy, and things. And so I get to see how they operate from the insurance side, right? Do they tell the truth? Are they giving me this? Are they trying to do this and that? And when I see a really good operator, I tend to become a limited partner today. So that's Broadview Capital. That's Larry Abramovich,
so
right?
funny,
And the trailer parks. So trailer parks, really, because in the insurance space, we have a tough time with insurance. Why? Because technically they only own the pad, right? They own the pad that they're renting. Sometimes they own the trailers, but a lot of our clients, they only own the pads. So there's still a lot of depreciation and the electrical or the infrastructure, right, of the park.
If I remember correctly, it's been a couple months, I think, since we did the lot. We've done a bunch for you guys, believe it or not. And if I remember correctly, 85% of those properties were accelerated. 85. That's you can't do more than that because you have to make sure if you're in that market, it has to be paved. So all that pavement and the pads, all that gets accelerated. Now, if it's dirt or gravel, it's not going to be as good. But all the pavement and the light posts and all that stuff, yeah, 85%. That's crazy, right?
That's nuts. I didn't know. So I am a client. Great, because you know what? He just distributed. Larry distributes all the time. He's one of my favorite investments because not all of them distribute, right? So he's cash flowing. He knows how to operate, and so on. Question: how do bankers or lenders ever have anything to say about this, or did they ever underwrite to it, or anything like that when they're deciding on a loan? Just curious.
I need to pause for 1 second. I didn't realize I was unplugged. Can I pause for a second?
Sure, you can pause. Go ahead. We can edit it. You're unplugged. How? Oh.
My battery just came up. There we go. Sorry about
Oh.
that. I must have kicked it or something.
Right. Listen, I just crashed. My power cord's under my leg. Okay. So the question is really, and I don't know if this is true, but I'm just curious, how do bankers and lenders view cost seg? When investors are refinancing or applying for new loans, for example.
Well, they should be happy and they should be recommending cost seg because the debt service ratio is better when you have a lower tax liability by that kind of amount of money. they should be bringing it in. But do I get a lot of referrals from bakers? It's been a while since I have. I used to get more of them. But so, and depreciation is taken out of the equation too, so it's not going to have a negative impact on the, on the loan. But it should be only gravy. It should be considered
That
a
makes
positive.
sense. Because my banks on my investment properties, they want quarterly financials when they're personal guaranteed loans, not non-recourse. They want, they want everything. They want my world financial view. They want my income businesses. They want quarterly sometimes.
Right.
So
Yeah.
if they could see
But
that.
they back out depreciation, so
Right.
it's not.
Okay. Is there ever been a time where this is, not worked out, or when you told somebody, listen, I don't think we should do it because it's not going to benefit you enough? Has that ever happened?
Funny. It just made me think of one of my very first clients over 10 years ago. We always like to see it like at least a 10-to-1 ROI,
Right.
what they're paying and what they're getting. And this guy had, just a very low cost, horrible industrial property. And the ROI was like 6-7-to-1. And so it was almost
Got it.
going to break even on what he was paying me. And I said, yeah, I don't. I said, I don't see how this is going to benefit
Horrible
you.
meaning
He
too old?
he
Not
paid
updated?
such a low. Yeah, it was like a rundown. He paid a couple $100,000 for this industrial property. So it was almost going to break even on our fee. And he said, I hate paying taxes so much. I'd rather pay you this money, even if I break even, even if I come. That
you
stuck
instead of
with
the
me.
IRS. Right.
That's how strongly he felt about not paying taxes, but that's
Right.
that's so rare that we would have such a low ROI. It was just an unusual property that he got for next to nothing, and
Right. It was just the cost basis was too low.
No.
You probably didn't maintain it. I've been told sometimes if you, like, for example, I'm about to spend $33,000 on a roof on one of my 14 units, and I have not cost segregated it yet. Where does that play a role? Like when you have to paint a brand new building, or 5 years, you've done a cost seg or without a cost seg, and a new roof comes in. So if you can play out almost both scenarios.
I know where you can go to get a good cost segregation study done since you haven't done it. But
Right.
the roof would be part of that tax trick we talked about, the cash in the trash. So you're going to be able to write off the full remaining depreciable basis of that roof and get a bunch of losses for what you throw out. Now the roof is going to be 27 and a half years or 39 if it's commercial. It's not going to be accelerated, but but you can still accelerate whatever else is in the building yet to be accelerated and write off the disposition. So you can't do it without our study. You have to have the study that puts a number on that.
Right, the study is obviously submitted to your accountant, which eventually makes its way to the IRS, and they validate. Is that the process?
You don't actually turn in. You don't send the study. It's actually just your document, like your worksheet, just like your depreciation schedule. Yeah.
Right. So I like the 10-for-1 ROI, right? So that, folks, that means if your study costs $10,000, it's $100,000, ROI, right? 10.
But that's low. We usually see ROI far and above that, 50, 100. I mean, it's crazy money.
50,
Yeah.
100 ROI.
Oh yeah.
Right?
Oh yeah. I'd say it's 10 is bare minimum. Yeah.
Right. So this really works for someone who's got a business that's making, let's say, 7 figures, right? In a separate business, then has a ton of real estate holdings, right? Because most high net worth commercial real estate investors, I find, started in a business, right? Not like me, who started real estate first, then opened a business. But it's a no-brainer, right? If you got $1 million.
So I'm glad you're bringing that up. So we should
Right.
talk about passive loss restrictions. I'm not sure if everybody who's listening knows what that is. Let's say you have a day job, a day business. You're a doctor, you're a dentist, you're whatever. You own a factory. Mm-hmm. You can't go out and buy an apartment building, cost seg it, and use those losses to offset your doctor business. In that scenario, you have passive loss restrictions. So you can only use passive losses to offset passive income. So again, back to the doctor, making lots of money in the medical building, they can only use the losses to offset the rental income in that scenario.
Understood. Okay. So
Now, but if they have lots of properties and they cost like one, let's say, they can use the losses to offset any of the rental or other passive income.
okay, but not active income in my business.
Now, if you're a real estate professional for tax purposes, there's a lot of buzz about this and a lot of misunderstandings, okay? It has to do with time, not dollars. So that doctor possibly could be a real estate professional for tax purposes. And a lot of our clients are. They're kind of winding down. Maybe they're at a certain age and they're cutting back their hours. It has to do with hours. You have to spend 750 hours a year in real estate, materially participate in the real estate, and that 750 hours has to be at least 1 hour more than the other gig, the other business. So if that doctor does 749 hours a year in medicine and 750 in real estate, they can use the losses however they want. They don't have restrictions.
So for me, that would probably work. So for example, I've been buying and selling real estate since 2000, right? Yes, I still have other businesses in this business, but like I know that roughly, I think 2,000 hours a year is what you work, right? 52 weeks and so on. It's about 2,000 because you can take 2 weeks off. I know that because of payroll, right, for our staff. So for me, for example, you know, I'm always buying and selling every year. And I know my lenders back in the day before I had this business, they used to qualify my capital gains that I used to take every year as a professional real estate person as income after 3 years. That's from the lender perspective. So then, because I had minimum rental income, for example, but I was capital gains because I was, you know, building up my capital and equity, 1031. So I was considered a real estate investor at that time, right? And I also today, you know, I have 140 units plus retail plus this, and I'm a tenant, but I have a business. But I hired a property manager on a separate entity. So would this would work for me, I think, no?
The property manager, that you have to materially participate in the real estate. You can't just hire a property manager, write them a check. That kind of makes you passive. If that's your scenario. Your scenario is different because it wouldn't even matter if you have passive loss restrictions because you have so much rental income, I would guess.
Yeah, no,
It doesn't matter. But for someone else who's maybe just getting into the game or not, you know, it just depends on the situation. So something people should be
My
aware
property manager,
of
by the
are
way,
their passive. Yeah.
Right. He works for me. Meaning he's a mentee of mine, right? I brought him in to manage my stuff, and I pay him a percentage of our gross revenue and things. And eventually we started buying buildings together, right? Because his whole goal was to work for me so we can buy buildings. And for me, it was to be his mentor so I didn't have to be beating the street all day long, knocking on doors trying to buy properties, right? So it's interesting. Okay. So
It's something everyone should talk about with their tax professional. Do I have passive loss restrictions, and does it even matter? You know, do I have enough rental income where it's not a negative? So
right. Now that's huge because I had this talk with Noah Rosenfarb. I don't know if you're familiar with Freedom Family Offices. He runs Tax Thrive, and he said, "Well, are you a real estate professional?" And he says, "Well, I would consider you." So if you are still boots on the ground, right? So I have another friend who owns, their medical clinics, you know, about 6 or 7 of them, but he's 80% real estate, 20% that, and he's on a roof, right? So
oh yeah, so he's probably a real estate professional.
Qualifying. Right.
Yeah, and
a real
one thing
estate
to be clear, it has nothing to do with real estate licensing, broker's license. There's a lot of misunderstanding. People say, "Oh, I got to go get my license, so I'm a real estate professional." That has nothing to do with it. And if anybody wants the rules, I'd be happy to send them. It's a little bit more to it than what I'm saying here today, but.
Right. But here's my takeaway. Every professional investor that you work with, right, sophisticated, all right, they're doing it every single time, right? And yes, I have income. I've owned buildings for 20 years, same building, right? Some of them are paid off. I have a client who has 1,200 multifamily units. His whole goal is to pay off his debt, and he's in massive income, right? He's got over $1 million a month in gross rents. So, and it's funny, I don't think he's done this. So he's your first referral.
Oh,
Yeah,
goodness. Oh, my God.
I don't think he's done this. And he uses Appfolio, right? So like he's super organized on his receivables and his expenses and everything like that. And then we get our smaller investors who are like, they say to me like, well, we collect rents in cash, and I'm like, oh, great. This guy, when you get to a certain level, that doesn't exist anymore, right? You're not managing 144 multifamily units, retail this, in a cash world. So this gentleman, he's got 1,200 using Appfolio. Interesting if he's done it. I don't think he has.
You know what, Jerry? Every single day I meet super high net worth people, family offices, people with real estate all over the place who have not heard about this, who go to pretty sizable accounting firms, well-known accounting firms. For whatever reason, they haven't been advised. They just didn't know about it. And every single day I get to make them happy. It's really fun, but it is surprising because there are people like you're describing that I encounter regularly. Right. Yeah.
So I'll ask you a question. This is one of my favorite questions. What's the purpose of a business?
What's the purpose of a business? We have a mission statement, and I meant to have it on my screen, and I have it here.
You're going to tell everybody how to get a hold of you in a minute, but I always
no. Our company's mission statement, which they have.
But in general, not just your company. What's the purpose of a business for you personally?
Well, I'm lucky because it doesn't just provide me a living, but it provides me so much personal satisfaction getting to do this. So I get to make a living, making people happy, meeting cool people like you who want to introduce me to people they know. And so it's a super fun and rewarding business. I never have to be told to get to work. I wake up, I'm on the phone, I'm checking my email because I am on a mission to make sure that people know about this. And I get to do this all over the country. We do this everywhere in the country. So it's I don't know. Did I answer? Did I get that right?
Well, there's no right answer, right? But you align. See, people do business with people they like, I find, and who align on values, right? So I was asked that question 20 years ago, and they said, what's the purpose of business? My instant, 25 years ago as a Wall Street guy, I said, to make money. And he goes, And I said, what? And it sticks with me. And a lot of people don't understand. You do. The purpose of business, from this gentleman, who's a very wealthy guy today, is to help people. That's it. Period. End of story. A purpose of a business is to help people. And what he said to me, he goes, the bigger the problem that you solve for people, you get paid in proportionally to the problem you solve. And by the way, he goes, if you can solve these problems, you don't even have to, they're going to throw money at you because that's the law of the universe, right? And how it works. So I solved this problem for myself when it comes to insurance. And I'm like, okay, this is all we're doing. We're going to, because I can't tell you how many sophisticated real estate investors didn't understand that insurance is actually a variable cost that you can get down depending on 15 different strategic levers that we can pull that can increase your NOI. And that's exactly why I'm super happy to have you here, because this is just another one of those levers that a beginner real estate investor, or like the guy who I mentioned has 1,200 units, who's one of my best friends for 15 years. I'm almost positive he's never done that, right? But I also have a friend that I invest with. He's a retail king, and he does it every single time, right? Every single time, right? And so it's super interesting, right?
Yeah, we do solve the pain of anyone who goes to write a check to the IRS feels some degree of pain. Yeah, I feel kind of patriotic too when I write my check, but it's painful. The bigger that, there's an extent to my patriotism,
Right.
And so everybody I'm lucky because everybody hates the IRS, everybody hates paying taxes, and we do have the solution. We didn't invent it, but we know how to harness it.
Stacy Sherman is your trusted tax saving strategist. She specializes in real estate cost segregation studies. With her expertise at CSSI, she identifies overlooked opportunities that can significantly boost your cash flow and reduce your tax burden. Ready to save millions in taxes? Reach out today and discover what cost segregation can do for your portfolio.
Right. And you mentioned the other thing. When you do what you love, you never work another day in your life, right?
It's so much fun.
Right. I get the same comments all the time. They're like, you going to work? I'm like, I'm not going to work. I'm going to live my life, right? That's like, I don't think that way. When people say I'm going to work and so on. You mentioned the IRS. What do you think of our buddy over here, Doge? Right, Elon Musk. I think they just got rid of 6,000 IRS. Right, they let him go. Crazy times, right? Tax codes, crazy times. I know we won't get into politics, but And now you're in Florida now from Michigan, which is same. I'm Michigan, Miami, New York, Florida, but my brother's still in Michigan. All that we've had that talk, but now DeSantis, our local governor, he just implemented Doge in Florida, Department of Government Efficiency. He's doing the same thing. So I don't know. It's strange. Did you see that he also said property taxes 2 days ago? DeSantis, the governor of Florida.
I did not see the part about the property tax. I kind of ignored it. Yeah, because I kind of have whiplash right now from every day, every hour we get a new announcement. We also have a huge national deficit. So, if you're financially conservative, which I think a lot of listeners are, we have to be concerned about our deficit. So
100%. Yeah. Mm-hmm. So, but DeSantis said, he came out, went on a 30-minute rant about property taxes. And he goes, listen, every year property taxes go up, the assessments go up, you pay more. Florida has homestead. He goes, but it's like paying rent, and every year it goes up. And he comes out talking about stopping property taxes. So, there's a lot going on. And it'll be interesting, and no one knows the future. And obviously, every morning I wake up and I use my AI chat GPT, and I go, how many executive orders were signed yesterday? And I swear.
Oh, that's a good question to ask. That's a good question.
I'm in shock, right? Plastic straws.
Whiplash.
Right?
Yeah.
It's like whiplash. I've never seen anything like it. And to be honest, the stock markets, people are nervous, and it's what's probably going to happen is it's going to be great for your business, right? Because we know the last administration and how they think about no taxes, they're probably going to come up with, and obviously Trump is a real estate guy at his core, right? And so it could be a really good season for you, right? In this business over the next 2-3 years, where this, I always say that there's waves in life, right? And you don't have to be a good surfer, but when you're out there, and there's some people surf better than others, the wave comes, it pushes us all. So there's a wave for what Stacy Sherman does to help people, in everything that we've discussed today with dollar cost segregation. And I personally think I could almost bet 90% it's coming with new tax laws and so on. So it's going to be good for real estate investors, I think, right? And
we're lucky because this is a recession-proof business. Actually, we actually did great in 2008, 2009. Because when the economy is terrible, you can go into your buildings and pull out tax savings. You don't want to pay taxes when the economy is terrible. And then when it's great, people are buying and they're coming to us with their newly acquired properties. So it's usually just kind of steadily grown up for 20 years. Yeah.
Right. That's what people say to me. Oh, you're also in the insurance business? Isn't that a recession-proof business? And I'm like, maybe. I guess. And they're like, but didn't insurance just keep going up with inflation? I go, yeah, I guess so, but that's my job is to reduce it. I'm the first insurance guy that says, listen, let me find you a bank that can waive wind. And they're like, but what? And I'm like, yeah, because I'm a real estate guy first and helping people first and so on and so forth. So Stacy, how do people get a hold of you? And by the way, one last thing, you and I need to find an accountant that we can refer out to people that loves what you do, loves what I do, and other real estate. Because I still, in 2 decades, have not found a real estate accountant specialist. Now they say these two
I
are
have them.
specialists.
I have a handful. I have,
You
you know,
do?
a list of people
Okay.
I can send you to, but they're in Chicago or, you know, different. Florida's a little,
DC,
yeah.
right, old school. Okay, so Stacy, how do people find you besides the
Is my
description below? What's
Well,
that?
it's written below, right? Well, they
Of
can
course.
call, text, or email. I'm based in Florida, but I work nationwide. I even have clients in other countries, believe it or not, and they can reach me at my phone 216-272-3961. Can also text
Okay.
me there. And then my email, stacy.sherman@csssiservices.com.
Got it. And so the name of the company is
CSSI, Cost Segregation Services Incorporated.
awesome. So they can go there, you can find it.
Yeah.
So everything that we discussed, you'll see a summary below. Her contact information is there. So feel free to reach out. Her email will be there and all that good stuff. And listen, this was awesome, right? Because I'm all about real estate profit boosts, right? So I think, I'm already a client, right? Because I didn't even
Yeah.
realize it.
We
Isn't that
didn't
funny,
realize
though?
it. That's been
I'm
really
investing,
fun.
right? In who people that I believe in integrity and know how to operate, and I invest in those as a passive. And I'm the idiot that hasn't done dollar cost segregation in in years. You want to know why? I'll tell you why. Somebody introduced me to a gentleman. I'm not going to say any names, and they said, "Hey, we do dollar cost segregation, right?" And I do business with people that I think share my core values, like you, Stacy, right? Like helping people create win-win. We do things just like you. I'll do things to the detriment of us to help you because I know it pays off, right? That's my
Yeah.
law of the universe speech, right? If I breathe out carbon monoxide, the tree gives me oxygen. I'm a faith-based guy. God created it that way, and I believe it. So somebody turned me on to dollar cost segregation about 6-7 years ago. I got such a bad rub from their high sales push, high this, right? And I gave them, a building that I paid around $1.6 million for, and I think the estimate that they gave me on the dollar cost seg was like $35,000. They were taking a percentage of the tax savings, right, of the loss, the depreciation. So,
Wait, the
and
fee? The fee?
was a percentage
Oh,
of.
that's not acceptable. That's against the law. Because
See,
just to clarify, this is an engineering-based study. You're hiring us to come
Right.
out to the property and do this report. It's not based on savings. That is
Correct.
so not
it's
kosher. Yeah, it's
Right.
illegal.
right.
Yeah.
They didn't. Maybe they phrased it a different way. But I said, listen, how much do I have in savings? And they said, well, like you said, before you give a 10-to-1 ROI as your base, right? And you've given 100-to-1 ROI. But I just had a bad taste in my mouth when he said, listen, if I get you $200,000 in depreciation losses, I'm like, well, what's the cost of the study? He goes, well, he didn't throw the percentage. He says, it's about $35,000. And I said, and then, you know what I'm saying?
No.
So the moral of the story is,
No.
and one of the reasons we created this show is, listen, people underwrite real estate. They, and they look at numbers, right? ROIs, RRRs, return on investments, cash on cash returns. You underwrite an engineering study, right, that does this. But if you don't underwrite the people that you're working with, your odds of success are zero, right? And that's exactly why I have you here, Stacy, because you and me, we're friends and we think alike, and that's the most important. So I just want to stress that to people. You got to underwrite the people that you do business with. If you don't, unfortunately, the way the universe is created is you don't have good without evil, you don't have day without light, right? So it's out there. Trust, but verify. And this show, we'll do all the verification for you. They're not going to be on this show unless they're rock stars with the best core values ever. So, Stace, you're the best. Yeah. but
Thanks,
it's
Jerry.
true.
It's fun. It was really fun.
It was fun,
Yeah.
and we want to make it fun, and we'll continue to grow. So everybody out there, that's Stacy Sherman. She's a rock star. All the information's below. Share this. There's a lot of education in here. Boom. That's Real Estate Profit Boost with @JerryCatCEO all over the web. We created this community right here to help you scale in the world of commercial real estate. It doesn't matter if you're a beginner or if you're a seasoned syndicator or an institution. We will be interviewing the titans of real estate right here that share all their successes, their strategies, their execution, more importantly, and their biggest failures. Why? So you don't have to. So what you need to do is subscribe below, share this with a friend, comment, and let's create a community of learning and growing from the biggest titans in real estate right here on Real Estate Profit Boost.